who always coordinates all the webinars, and we have been doing for quite a while this, and every Friday at 5:30 Indian Standard Time. But unfortunately, he is not well, so I request Dr. Arvind Firmani to kindly chair the session, and then we will follow as usually. She will talk about 30 to 40 minutes. Then there will be question and answer about 10 to 12, 15 minutes. And then I will conclude by giving thanks to all those. So this is a broad format. So over to our chairman, Dr. Arvind Virmani.
Thank you. Professor, let me welcome you. Unfortunately, as we got a slightly disturbed because Dr. Charan Singh got COVID. I mean, there's no harm in mentioning. So he's actually in hospital. So, we are very happy that you'll be speaking to us. And as Dr. Vishandas has already introduced you, and we've taken a little bit of time in getting started. So please, why don't you just start? I guess you will just tell him when you want it changed. I guess Vivek is ready. So you will tell him next slide and so on, right? So please.
Okay. Well, thank you very much for the invitation, and sorry to hear about Dr. Chandi and COVID. I hope he's well, but you know, anyway, it's a pleasure to be here. So the topic of this talk will very much European related, but I think the lessons are probably of general interest for other central banks around the world. And, you know, let me start by saying something that everybody knows. So since 2008, the great financial crisis, the role of central banks in economic policy and financial intermediation has greatly expanded. And these were the effects of two large shocks, the crisis, the financial crisis, and then more recently, the pandemic. But it's not just the two shocks, it's also that the average size of the balance sheet of the central banks have increased on a persistent way. So there seems to be a new normal about what is not monetary policy. And this has been a challenge for what were supposed the good principles of economic governance, on which there was a broad consensus since the 90s around the notion of narrow central banking and inflation targeting. Now, in the euro area, this is particularly stressful because we are in a monetary union with a common central bank, but different fiscal jurisdictions, which have, which drives their own fiscal policy and they issue their own debt. And so they face different risk profiles. So I think as a consequence of the events of the last 15 years and what is supposed to be a new normal, there is a need to rethink the institutional design governing the relationship between monetary and fiscal authority. And I think this is true for the euro area, but probably is also true worldwide. So this talk will elaborate on these issues, and I will start with the first slide, if you can please give me the slides, the next one, which is give you the ratio. No, the previous one, please. The previous one, okay. This gives us the ratio of asset to GDP in the central bank balance sheet. This is on an average for different advanced economies. These are historical data. And you see that on average, across advanced countries over time, specifically since the 1900s, you can see that during the Second World War, there was a peak in the balance sheet, and then after the financial crisis, okay? So here I'm stopping just before COVID. So clearly war and financial crisis are special events in which the central banks intervenes, and this intervention, you can see it, one proxy for it is actually the size of the asset over GDP. So there are these two spikes, but there is also, quite a lot of persistence in the size of the balance sheet. Now, if you give me the other slides, I will zoom for most recent events. Please, the other slide. Thank you. So these slides, in the blue line, you see also the asset over GDP for now for the euro system, so the central banks in the euro area. So that's the blue line. And now I'm zooming to a recent event, so to recent years. So this starts from the new millennium. So you see that the balance sheet increase, after the failure of Lehman Brothers. Then it stabilized, then it had another big jump during the European debt crisis. And then actually, then there was QE in 2015. And then now with the pandemic, we had a huge jump. So here, not only you see these jumps, but you also see a tendency for these balance sheets to grow over time in what, seems to be a new normal. So the points I want to make is basically, I want to make 3 points, and then I want to draw some lessons from the future. So slides, please. The first point I want to make is that there has been a shift in paradigm. Now so the way in which monetary policy is conducted is quite different from the 90s. Balance sheets are used actively, and they are large on average. And this is something that I will argue is here to stay. Now, the new policies, which is quantitative easing, forward guidance, the various policies that central banks around the world put in place, they affect the size and the composition of the assets. And, I will describe how these work and why I think, there are policies that are likely to stay. And also, I will discuss why they are effective and what are the conditions under which are effective. They are not always effective. And this will allow me to, to draw some lessons for the future. Slides, please. So the first point I want to talk about is what is this shift in paradigm in monetary policy? And here I will argue that the intellectual paradigm has changed for many reasons. The first is that, let's think about what did you used to think about, how the financial system and the economy work. We used to think that financial frictions were small, and that the efficient market hypothesis was a reasonable working approximation to understand the transmission mechanism of monetary policy in the financial system. We also used to think that financial quantity in general, and in particular the size and the structure of the balance sheet, were irrelevant, okay? So that this is why, in the old world, the main instrument to affect inflation was the short-term interest rate on the bank's refinancing, on the central bank, on banks' refinancing operation, and through this on the other short-term safe interest rates. The key discussion at the time in the old normal were on how to change the policy rate, often tailored in terms of some feedback rule from inflation, as well as indicators of real activity or some indicators of financial stability. So research and analysis were devoted to understanding how changes in the safe short-term interest rate change the riskier and long-term interest rates, and through all of them transmitted in the economy, allowing in this way for central banks to manage fluctuations in credit and savings, and through them inflation. I would argue that now the consensus has quite shifted. Financial frictions is understood are pervasive, not only in the heights of the financial crisis, but also in normal times. Financial markets are imperfect. And this breaks the transmission between the short-term rate and the long-term rate. So central banks also now have new responsibilities beside monetary policy, but they also have more instruments. And central banks have now a sort of market-making role beyond the traditional lender of last resort role, and I will give you some examples. So balance sheets are large and used proactively, also when interest rate is away from the so-called zero lower bound. As a consequence, there is a new reality. So non-standard policy have become the new normal. After all, they've been used for more than 15 years, so it is time to call them a new normal. You know, this policy work also away from crisis time, and they serve both monetary and financial stability objectives. I will also argue that the reason why it will be difficult to go back to the past type of monetary policy is because the world is quite different from the world that we face in the 90s. So there is an excess demand for safe assets, which will continue to be large because of precautionary savings, because of demographic features, because of the leveraging, you know, the high debt situation, from the high debt situation in which we are now, because there is uncertainty about many things, and especially about new risks emerging, like climate, technology, the health. And of course, also, you know, the debt, the public debt that we have accumulated is going to be with us for a long time. So, you know, pushes the central bank to be in a special situation. So let me get then now to the bulk of the discussion, please, the slides. I want to talk now about my second point, you know, what are these non-standard policy? Can we have a taxonomy? Can we kind of classify them in order to understand them and, you know, to understand the function that they may have also in the future? I will argue that there are two types of policy, of non-standard. The first, which I will call passive, unconventional. What does it mean, passive? It means that they act as a complement of interest rate policy. So they also, they can be used also when interest rate is away from zero. And they're used when markets are disrupted in certain corners so that there are spreads that emerge. And so the central banks intervene to maintain the normal channels on monetary policy transmission. So in this way, you know, the central bank intervened to support financial intermediation, and it has, in that sense, a market-making function. Because of this intervention, you know, the size of the balance sheet expand endogenously, but I mean, the objective is not to expand the size of the balance sheet. The objective is, you know, to go and, you know, repair this transmission mechanism and by various, you know, ways, and as a consequence, the balance sheet size increases. And I will show you some examples later. The second type of policies is what I call active unconventional. They are actually substitute for conventional policy when the interest rate reaches zero. Okay, as it is now in many countries, interest rate is zero or even negative, and so at that point, these active policies, you know, purchase long-term data securities in order to affect the long-term interest rate and the risk premium and the term premium. So this policy act by reducing the returns of safe assets, pushing investors along the risk and maturity spectrum. So this is the typical, you know, canonical quantitative easing policy. Let me just give you some examples. The first example I want to give you is what happened in Europe, but then also, you know, in the US and so on, which was the liquidity crisis of 2007-2008. In Europe, I mean, actually in the world, the first symptoms of the liquidity crisis in the banking sector emerged in August 2007. And then with the collapse of Lehman Brothers in the US in 2008, there was a series of bank failures, and which and then as a consequence the economy entered in a very bad recession. In this situation, what happens? That the interbank market collapses, and the stress in the interbank market can be shown in the next slide. The next slide, please. Where here you have, you see, the spreads between the secure rate, the Euribor, and the unsecured rate, so the Euribor, and the secure rate, the Eurepo. So when, these spreads in gray here increase, that means that there is a stress. I mean, basically that corresponded to the idea that banks did not want to lend to each other because they felt that there was a counterparty risk, okay? They did not trust their counterparty. So here you have the first symptom of the crisis, and here with Lehman, the spike, in 2009. So what happened then? Okay, in response to this squeeze, this liquidity squeeze, so some banks really could not borrow in the market. The ECB intervened and replaced the market. That's what I mean, market maker. The ECB put the liquidity and started being the lender itself. If you give me the second slide, the other slide, I will show you how this works. Please, the slides. So here you have the savers, and here you have the borrowers. This is the interbank market, so where banks with excess liquidity lend to banks which have, a deficiency of liquidity overnight. Okay, so that's, the interbank market. Then with the squeeze, can I have the next slide, please? Slides, please. Okay, with the squeeze, the interbank market collapsed because of this mechanism I show you. And then what happened? Next slide, please. Next slide. Okay. And the ECB balance sheet replaced, that, web of connections that you've seen before. So basically, the banks now records, with excess liquidity, deposit on the ECB balance sheet, the increasing reserves, and then the banks with deficiency of liquidity borrowed from the ECB. And, this is the intermediation chain, if you want, was restored in this way. So in that sense, I call this action, the central bank became an intermediary of last resort. As an effect, of course, the balance sheet of the central bank increased, but, this is because they were trying to repair the financial system. Another example is more recent, is, for example, what is called the Pandemic Emergency Purchase Program, which was announced in March 2020 in response to the pandemic. Again, when the pandemic struck, there was a liquidity dried out. And this program, the Pandemic Emergency Program, had a dual role of stabilizing financial markets and contributing to easing the overall monetary policy stance. So the stabilization function through purchase implemented in a flexible manner over time across asset classes and countries, were acting to ease financial conditions where financial conditions were tight. And if you give me the another slides, please. Slides. You could see this was the announcement of this program in March 2020. And, after some hesitation on the design of the program, the sovereign yield of all the countries in the Eurozone started declining, but also you can see a decline of the corporate bond in the corporate bond yields. So this implies that the stress was eased and financial conditions were eased. Now, these are the examples of what I call passive policy. Okay, so balance sheet increases because you go to intervene, to become a market of last resort. The second kind of policies are the traditional quantitative easing that you may be more familiar with. In Europe, we implemented it only in 2015. But also, now we are implementing with this PEP program since 2020. Another example, which is important for the point I want to make, is what Europe did in 2010 with what we call the security market program. In May 2010, the ECB established this program, which consisted in buying sovereign debt of countries which were stressed. At the time, we were in the middle of the Greek crisis, so the Greek state was going bankrupt, and other countries were very much, stressed by liquidity, by market attack on their in the sovereign market, so that interest rates started spiking up. So the ECB intervened by, a quantitative easing program. And, if you give me the other slides, please. Slides. I can show you, this is the first slides I show you. In blue is the size of the balance sheet. You have here is this security market program that was put in place in the middle of the debt crisis. And here is the traditional quantitative easing that we introduced in 2015. So just to give you an idea of the size of what that meant for the balance sheet. Now, next slides, please. So now that I gave you the taxonomy on this policy, let's see how they really work. Okay, so passive policy, I already said, they work by expanding, so that by intervening in particular market, as a consequence, the balance sheet expand. The important thing to understand is that this liquidity provision by the central bank satisfied entirely the demand for liquidity from markets. We say this satiates the demand from the market. And an increase in the size of the balance sheet with no change in the current or expected interest rate has no effect on inflation. So you can expand the balance sheet without, affecting inflation. And, this is clear because since demand is satisfied, is satiated, the extra reserves would have no effect on expected liquidity premia. And so with no change in the nominal interest rate, then, the so-called Fisher equation would tell you that expected inflation would be unchanged. Now, for passive policy, so the traditional quantitative easing is much harder for economists based on traditional theory to understand why this may work. And so, so in theory, a change in the relative supplies of various assets, like we do with quantitative easing in the hands of the private sector, there should have no effect on equilibrium quantities and asset prices. So for this policy to work, there must be mechanisms that make assets of different maturities imperfect substitutes, and for the neutrality proposition to break down. So in that case, asset purchases can affect long-term interest rate by reducing the risk premium, therefore relaxing financial constraints when they would otherwise be binding. So for these things, for this policy to work, we really need to have very substantial disruption in financial markets so that, these arbitrage conditions do not break this neutrality proposition. The experience in the US and in Europe is that actually this policy do work because financial markets, even without the extreme stress of a financial crisis, are actually pretty imperfect, okay? And this relates to my first first observations that we now have understood that you know the assumptions of perfect financial markets is not a very good approximation of how the world works. But here I want to make so I made this point, okay, so how the two types of policy work, okay, how we should understand them. In both cases, you know, we should look at them as policy which affect financial prices rather, you know, they affect the size of the balance sheet, but in so doing, they affect interest rates of various kinds. So, you know, so they have a price effect. Now, to understand the effectiveness of, especially of the active policies, I want to make now 3 new points. The first one is that in order for this policy to be effective, the credibility of this policy has to be supported by the state, you know, and the central bank alone cannot do it. The second point is that this policy have to be coherent with what Treasury does at the same time with fiscal policy. And the third point is that they have to be clearly communicated. Let me first talk about the role of the state. I think there it's very important to compare the program which I just described, the security market program, which was implemented in 2010, with another policy which was implemented in 2012 that, you know, I think it became very famous in the world, is when Mario Draghi, the president of the European Central Bank, declare in the middle of an attack by market on sovereign, you know, a speculative attack. He basically said, with our mandate, the ECB is ready to do whatever it takes to preserve the Europe, and believe me, it will be enough. Now, this word completely calmed the market at the time. So these were very effective words. So, and they were related to an announcement of an uncapped support to sovereign under certain conditions. Now, so the OMT, this program, worked very well, while the program I described before, the security market program, did not. So what was the difference? The difference is that you know, in the case of the Mario Draghi announcement, you know, the announcements were that the scale of the potential bond buying was unlimited. While in the case of the other program, you know, it was announced as something temporary and something in which, in any case, the central bank had to remain a senior claimant in case of a credit event, and it was also introduced in the middle of the big political struggle between Germany, the northern countries of the monetary union, and the countries of the south. In fact, Axel Weber, who was the president of the Bundesbank, resigned in 2011. More significant than any of the specific aspects was the fact that the institutional context by 2012 had changed. And this measure by Draghi was backed by a political agreement between the major countries, which was not a condition that was there in 2010. So in other words, the credibility of the OMT was, of the Draghi thing, was due to a new bargain with the sovereign fiscal authorities on shared responsibilities and involved some new institutional buildings in terms of reforms of our governance. If you give me the next slides, please. The next slides. You could see what I'm saying. Okay, so this is the security market program in 2010, which you see that even if more than 200 billion of purchases were put in place, interest rate actually increase rather than decrease. You can see it in this segment here. And this is the 2012 Draghi speech where interest rate actually declined. So these are the government bonds of Italy and Spain, so the countries which were really under attack here. So, the political support for this second measure was essential. And this is my point, okay? So the central bank, even an independent central bank, needs political support for its credibility. Also, in order to ensure effectiveness, monetary policy has to be coherent with fiscal policy. So fiscal policy cannot do the opposite of what monetary policy is doing, because otherwise it's not going to work. Active policy in particular, so policy which aim at long-term interest rate, have a large fiscal imprint, since by affecting long-term yields, given the fact that the average maturity of the debt is relatively long, they immediately affect the returns on government debt. So one way to understand fiscal monetary interaction is to start from the general government intertemporal budget constraint as an equilibrium identity that links the market value of the debt to future discounted primary surpluses. And, in empirical work that I've done in my research, I show, and this is a paper that was presented at the Bank of International Settlement recently, we find that when this unconventional policy was implemented in the euro area, it had a big effect on real returns on government debt. So that created fiscal space. So in principle, government should have responded by declining the primary surplus. But in fact, fiscal policy did not take that space. And eventually, the response on inflation and GDP was quite muted. Now, so this is my second point. So the first point, the backing of the state. The second point, congruence with fiscal policy. And now the third point, you need to have a clear communicated framework. And if you give me the next slides, please. The next slides. You see here, these are the reactions of market at the time of monetary policy announcements. You see, when there is volatility, it means that the market is not really getting what's going on. And you see that, really the volatility started declining only after QE was implemented in 2015, because eventually the ECB got the green line to use all these different instruments, and so the market got reassured. While here, even under Draghi, there was quite a lot of confusion from market about what the ECB could do and what could not do, given the lack of fiscal support. So this is in a way is also related to point 2. So you need to have, a clear mandate for what you're doing, because if the mandate is not clear, then the market is confused and then the policy doesn't work. If you give me another slide, please. This confusion had a it was very costly for the euro area. These are inflation expectations for the US, and so this is the swap 5 years inflation expectation. Here you have the US, the blue, and the red is the euro area. You see that before 2012, there was a complete correlation, very close correlation between the US and the euro area. But then, since after 2011, 2012, there was a decoupling. So, the euro area was not as successful as the US to actually to keep inflation high. So the red is the US and the blue is the euro area. And, inflation started, declining very dangerously towards zero and then stabilized well below the target, which is 2%. And, there is a substantial gap with the US. If you show me the next slide, please. The next slide. So this is my calculation in which I try to decompose inflation into trends and cycles. And, the calculation shows that this kind of decline in inflation is explained by the persistent component in inflation. It is actually the trend which suggests that a desanchoring of inflation expectations in the euro area, which did not happen with the US. This is the comparison between the trend estimates in the two cases. Now, if I want to wrap it up in the few minutes that I've left, I want to give you 4 lessons. Can I have a slides, please? And then the next slides, 4 lessons. So the next slide, please. Okay, so the first lesson is Hamlet. And the question is QE, not QE. The lesson is hesitation has a cost. So we have seen that since 2012 up to the end of 2014, when QE was eventually implemented, inflation started declining in a persistent way, while a policy announcement created volatility in the market. I show you that in a chart. So hesitation in the euro area, postponing the implementation of QE was linked to concerns about risk distribution effect of asset and the distribution effect of asset purchases across country. And but ultimately, these are concerns of governments, not monetary policy. So, this gives you an idea that, the hesitation is linked often by the lack of a clear mandate. The second lesson, please, the slide, is Samson. So where is the origin of the central bank power? And here, the conventional view, and here my point is that the power of the central bank ultimately comes from the backing on the sovereign. The conventional view was that the central bank's power derives from its accumulated credibility in maintaining the value of the currency, that is, from the effectiveness in delivering price stability. But the experience of the ECB demonstrates that the power of the central banks comes ultimately from the backing of the sovereign. When the market perceives a lack of consensus and questions the willingness of the euro area governments to back the central bank, then notwithstanding the immense powers that in principle a central bank has, because it has the monopoly of money creation, then the credibility is lost. And here, the example which is relevant here is this difference between the security market program in 2010 and the Draghi program in 2012. The first one did not work because there was no political backing. The second one works because there was a political backing. The third message, and here please the chart, a chart please, is the power of institutions and their design. So that the previous lesson leads to this, is that it's very important to have a clear institutional framework which links the fiscal authority with the monetary authority. A complete separation between fiscal and monetary authority, as in inflation targeting, is not the right framework anymore in the new economic circumstances. So ultimately, central banks need to intervene to defend financial and monetary stability. And the separation has 2 problems. The first is the risk, including fiscal risk, may be the consequence of that intervention. So they have to be managed, this risk, by institutional arrangement and the backing of the states. And the second problem is that in some occasion, you need coordination between fiscal and monetary policy. I mentioned my research showing that, fiscal policy was not congruent with monetary policy in the last part, in just the 5 years before the pandemics, which meant that the effect of this very aggressive policy on inflation was limited. And the last question, the last lesson, and here another slides, please, it will be my last, is Marx and the historical determinism and the formation of the ECB. I mean, I don't know if really is Marx the right guy to be put there, but here is to show that history matters. And the euro came into existence with the Maastricht Treaty in 1992. Its creation has been seen as a product of the forces driving the European project. Its timing was a consequence of the political dynamics among Germany and France, and in turn, a consequence of external events, including the reunification of Germany. But what is very important to understand about the creation of the euro is that it was a compromise that was accepted because the design of the treaty is that the European Central Bank was a completely independent institution which should not interfere with the fiscal authorities. They had to have, a very narrow mandate, just in terms of inflation, not in terms of financial stability. And this consensus was possible because the intellectual, this compromise was possible because the intellectual consensus, even among academics worldwide at the time, was that that was the right framework. Now, history has changed. We have new problems, and then we need to adapt the framework to the new challenges. And, this was abundantly, showed by the 2008, 2009 crisis, and now with COVID. But, so the intellectual consensus has changed. And therefore, since history matters, we need to adapt our institutions. Without the adaptation of our institutions, we will not be prepared to meet the challenges of the next crisis. And I finish here. Thank you.
Thank you. Fascinating talk. Let me just make a couple of points. It's particularly interesting because, it's interesting because these are some of the things we in India have been saying since our 91 reforms, actually. And I want to make 3 points. One is, of course, about imperfect markets. In our management of monetary policy, and I've been connected with that from the finance ministry side, not the central bank, for decades, is that markets are imperfect in emerging markets like India, and therefore we cannot follow the policy framework, the monetary approach, which I used to call it Wall Street Chicago complex adopted. So in some sense, I think what you are saying, if I've understood you correctly, and if you please correct me if I'm wrong, that many of these changes, which in some ways bring your monetary policy approach closer to what we've had for the last 30 years, since the liberalization in 1990s, is bringing it closer. Just to state one element of it, for example, I used to differ with our former governor, Raghuram Rajan, who was a Chicago man and really believed in the Chicago Wall Street approach, was that transmission requires long-term liquidity, that what may work in New York about transmission from short-term to long-term, across the spectrum, because we even have informal markets. So forget the formal market, we have lots of informal markets, and the transmission to the whole economy is very problematic. And therefore, the issue of liquidity is a separate issue, short-term, long-term, etc. But I mentioned these only because, as I said, that to some extent from your talk, I understand that you moved a little bit closer to the approach we've had in India. But of course, our markets used to be much more imperfect. The second point I would make is on the Greek crisis. Well, I happen to be the executive director at the IMF, representing India and other countries during that critical period. Actually, it was great fun. But I was on the other side. I argued actually. In fact, I think I wrote 2 or 3 papers on that, and I gave a talk in Canada. Was that without a certain amount of debt write-off, which, if I remember correctly, of course I don't, at that point had reached something like 40%, and there was doubt whether even that was enough, maybe 60%. The Greek debt crisis would not be solved. Of course, it needed reform. So my proposal was structural reforms plus debt write-off. And of course, the IMF traditional approach was different from that. And here, I would like to know how right or wrong I was. I mean, did that eventually get written off? Because I didn't really follow it after I came back to India, which was in late 2013. So it'd be interesting to just hear what your kind of recap of that is. For Greece particularly, I think it worked in Ireland. In fact, I visited Ireland during that time. And for Ireland, that whole program of the IMF seemed to work. But on Greek, I was pretty clear, and I may be wrong. If you have information, maybe I was wrong. But that was my view at that time. And the third point on the fiscal monetary coordination, I'm glad you mentioned that specifically, because here I think there is less. There was more confusion. Of course, during the pandemic, I emphasized this. We wrote a series of papers. I think the last one was specifically on fiscal and the monetary coordination. But I also happened to be on the panel of economists, which RBI governor invites every 2 months before the Monetary Policy Committee meets. And I've been saying it there for I think almost maybe a couple of months. Of course, the initial issue. And basically, here is congruence. I think it's very similar to what you're saying, that the key point here was exactly the same. It's interesting, which we made in those committee meetings, was that RBI has to do everything to keep all the markets liquid, not just focus on the government securities market, but all the others, given the pandemic and the enormous scale, the lockdown we had, which covered 60% of the economy for something like a month and a half or 2 months. And given all these things and the pandemic, that was one. And second, that the fiscal, we said, has to be consistent with this. And what the government did, which may be of some interest, was for certain segments of the market where it would be too risky for the RBI to provide credit, the government provided credit guarantees. So it backed up the actions of the central bank, for example, for non-bank financial companies, which were more risky, or for small enterprises. So selectively, where there was a danger of the risk premium jumping up, government provided something, if I remember correctly, 50% type of credit guarantees, share, part of the credit, and very carefully defined. I think it worked very well. And of course, the other element of this was the decline in, like I mentioned, with 60% of the economy closed for two months, the tax revenues collapsed. There was no tax revenue, okay, because what was functioning was so-called essential commodities, most of which had very low tax rates to start with. So the point we made, and again, here your views may be of some interest. The proposal I made, and it's in one of my EGROW papers, is that for the decline in, of course, you know very well that decline in taxes during such a situation acts as an automatic stabilizer. But what I argued was that the RBI must cover the known and calculable, very easily calculable effect of the lockdown on the tax revenues. That if necessary, they should fully monetize that debt. If there was no market for it, the government, I mean, the RBI should monetize that debt. So anyway, these 3 points you may choose to respond now, or we can take up other questions. If you want to take a brief
let me respond, since
Yeah.
you put quite a lot of meat on the table. So yes, I think it's interesting what you say about arguing with Raghu Rajan, but I think basically in crisis the separation, I mean, the good principle of central bank is that you have to give liquidity to anybody who wants liquidity, and this liquidity has to be short and long. The idea is that you should give it against collateral, okay? And the collateral has to be, good enough. But of course, in a crisis, you cannot distinguish between liquidity and solvency. And okay, when the central bank starts messing around with solvency, obviously that's a problem, okay? Because in principle, the Treasury should take the responsibility to deal with solvency issues. So there is a division of work, and which in crisis is never going to be perfect. But I think the principle that the central bank does liquidity and the Treasury does solvency because taxpayers' money are at risk, I think is a good principle. So the challenge is to have an institutional framework that allows for coordination, but actually keep this separation. So that's my first point. On the fiscal monetary coordination, again, the same. I mean, okay, during the crisis, the financial crisis, what happened was that monetary policy tried to push the economy, while fiscal policy went in the opposite direction. While during the pandemic now, we are doing it right, and exactly like you are suggesting. So governments are giving moratoria and guarantees, and that is supported by the ECB. Now, whether this is going to be monetization or not, okay, is to be seen. I mean, I think the interesting the experiment is the one in the United States, in which they are going extremely, gung-ho on fiscal, and also the central bank has relaxed the inflation target. So I think that kind of is an implicit monetary policy coordination. Of course, in the US, that's easier because it's just one country. For Europe, it's more difficult because the risk profiles of the different member states is different. So, but, I think that the world is going in that direction. There is no doubt. Now, on the Greek crisis, just for information, I totally agree with you. I mean, that we should have restructure at an early stage, but the ECB didn't want to do it. That was a mistake. So then we did eventually restructure, but it was too little, too late, and then eventually it was a huge amount of restructuring in Greece, probably the largest in I don't know. I mean that we have known and in history, and that eventually things in Greece are now getting better, but
roughly when was the large restructuring? Roughly which year do you recall? The large restructuring.
There were two, right? There was one in 2012.
Right. The second one, yeah.
The second was in 2013, I think.
Okay.
Just after.
Yeah.
And so, now things are going better, but, we have wasted a lot of time at the cost of the Greek population. Yeah, that's my answer. Thank you.
Okay, any questions? I don't see anything in the chat box. If somebody wants to ask, they can ask in the chat box, or they can raise their hand, switch on the video and raise your hand or something like that.
Good evening, sir.
Prabhatra, Jenna, you want to ask a question? Go ahead.
Yeah, sir, this is Pavitra from Sri Mata Vaishnav Devi University. So I was just listening from like Professor Lureskia that she has given a nice lecture. So that my doubt is there, like nowadays the people are doing research on like how like different age group actually they are like responding to that monetary policy. So I want to know from her what is the effectiveness of that demography for what is the impact of democracy on effective monetary policy? How young generation they are when the rate of interest is changing, like repo rate or reversible, how young mass they are responding, how that older generation they are responding. So so that I need to know. So the second question is that now there is another channel is emerging instead of interest rate and exchange rate. So that is now the non-banking financial institution playing a major role, because that credit card is playing the major role for liquidity and all this. So how the rates of non-banking financial institution companies is important for monetary policy transmission. So these are my two questions. So
right, on the demography, I mean, I know the ECB is doing a lot of research on communication to the public at large rather than just the market. And I mean, the question is, does it really matter? Okay, so should we also, for the effectiveness of the monetary policy, I mean, there is an argument about communicating more clearly to everybody so that everybody understands what the central bank does. But I mean, in terms of the transmission mechanism, what are the expectations that matters? So I don't know the answers of how will it change with young to old. I mean, of course, the expectation not of the market but of the companies really matter. And we know that actually those expectations are much less reactive to monetary policy announcement. And actually they follow very much oil prices rather than the target and the announcement of the policy of the ECB. Or the ECB or central banks. This is research that comes from Japan, from the US, and from the euro area, as far as I know. Okay, I don't know if there are other countries where this research has been done, because you need to have quite detailed data on. Of course, I think it would be interesting to understand how you reach actually the price makers, and then. But we still know very little about that, frankly. On credit cards, I think that's an excellent point. I think in Europe we are our financial system is very much bank-based, so everything that has been estimated and so on is very much based along and also the way in which the ECB does operation is through special loans to banks. So, of course, in a more market-based system and, in which there are different agents in these markets, then even the operational framework will have to adapt to this new situation. Now, there is an active discussion on, for example, on digital currency, and, and I'm sure that, the world, that's really another discussion, okay, that the world will evolve, with the spread out of digital currency and digital platforms, and most likely, I think that where we are going is that the central banks will issue digital currencies, and the public will have the right to have reserves at the central banks, but that's for the future. Yeah.
Thank you.
Thank you.
Dr.
Yeah.
Vigneshwar Swami, you have a question? If you're going to ask, why don't you switch on your video so we can see you? And your yeah, okay, go ahead. Can't hear you. Unmute. No, I think there's a problem, so I may have to read out your question because you are not muted, but I can't hear you. Okay, I'll read out the question. He says, can we know briefly what is the experience of ECB in terms of containing exchange rate volatility?
Sorry?
Exchange rate volatility, is that an issue in the ECB?
Well, the ECB, pretends that it doesn't really, I mean, it looks at exchange rate only insofar that this is affect inflation. I don't think that in the euro area we have the same issue of exchange rate volatility that emerging market has, because our debt is tends to be in local currency, not in foreign currency. But of course, exchange rate has an effect on inflation, so indirectly, okay. So to the extent that inflation matters, exchange rate also matters. But I would say that this is an indirect concern.
Thank you. Professor Ashok Viswandas,
Yes.
you have a question?
Yes, sir. Rachelin, it was very good presentation. I have very two small questions. You talked about the power of the institution and their design, and then interbank money markets collapsing. Now, do you see any design problem in the power of the institution, or let me put this way, can the design be re-architectured so that the interbank markets don't collapse in future? That is question one. Second, you talked about some country have the nominal sub-zero interest rate. Do you think something will follow in Asian countries in foreseeable future, next 5 or 10 years down the road? Thank you.
Well, the interbank market is very fragile, so it's. I mean, it's a very important source of bank funding, and and therefore, it's less so than before 2008 now. But it remains. It's fragile. But now we know how to deal with it, because the central bank can replace it in periods of stress. Now, as for the zero interest rate, for emerging markets, well, I think there is a way to go, because given your high growth rate and inflation rate and nominal rates to a certain extent reflect that. But at some point, I mean, you cannot exclude it that at some point. I mean, I don't see coming anytime soon, but it's. With the demographic pressures and pressures on the growth rate and the demand for safe asset, those pressures are there globally. So.
Okay. Anybody else? I don't see any chat questions. Anybody want to?
Actually, I have another meeting because I put it in 1 hour in my agenda.
No, that's very good. Okay. Are we? Yeah, we have finished. We have very good. So thank you. Let Ashok, do you want to say anything to conclude?
Myself or no? No.
Yeah, just 1 second. I take this opportunity on behalf of EGROW Foundation. I profusely thank Rachelin for giving very masterful exposition. It was sheer delight to listen to you. But as you say, that all good things in life come to an end, and today's discussion was no exception. We were greatly and immensely benefited by your talk. It gives us a very different perspective of how the institutions are collapsing, what was the Marxism and the financial institution. It was absolutely delight. I take this opportunity to thank our chairman who steered this session very ably as always, and he also brings so much experience and his wisdom on the table that we always get benefited. It is again a joy to listen to his intervention, which are very well connected with the talk, but yet it gives a different tangent. I'm thankful to all my viewers and those who asked the question. It was a dear fry. I want to add very small announcement for the next session, which will be.
Okay, I will have to stop. Thank you very much.
Yeah,
because
thank you very much. But
you.
other participant may stay for a minute. So thank you very much, Raishlin. The next Friday, the same time at 5:30, we will have very important discussion on new monetary policy in the wake of the GFC and the pandemic by Raghvendra Jha. He is the ED Executive Director in Australia South Asia Research Center. And I request you, this will be very, very good discussion next week. So I request my friends, my other participants to join us. And this session's discussion will be communicated and will be shared as usual. So thank you very much to one and all, and especially to Professor Arvind Virmani ji, and he always steers, as I said, very good. Sir, last word from you.
Yeah, no, I just wanted to remind them because the video of the talk is generally up on our website by noon the next day, so they can use it.
Yeah, that will be there as usual, and we are going to follow this. And so thank you one and all, and have a great weekend. Thank you, sir.